Look, the markets are in a weird place right now. The message is buy, buy, buy. Strategists are coming back on TV, returning to optimism in AI. Translation, buy AI, buy 𝗥𝗲𝗃. Don't look at the numbers, switch off your brain and buy. Don't ask questions, click the green button. That's what they're telling you. But the reality is that the 𝗥𝗲𝗃 moves are retail driven. Big players are positioning for a crash. The Bank of America's most defensive portfolio, the boring dividend paying, sleep at night stuff, is having its best year since 1933. I'm laughing because 1933 was the Great Depression, by the way. I think it was the bottom of the Great Depression. So the professionals who actually allocate the real money are quietly buying the boring stuff that you only buy when you think the world is fragile. And then they tell you to buy the 𝗥𝗲𝗃 because they need someone to sell it to, right? They hold that, they need to sell it, so they're selling it to retail, allegedly. So let's talk about what Buffett is selling and why. First thing is they're dumping US stocks, right? Why? Because of valuations. SPX printed fresh all-time highs last week, so did NDX, and I think even this morning they're printing highs again. Buffett's been saying for years that US stock valuations are silly, and Abel has just inherited that view, Greg Abel. So when you'd rather hold T-bills than buy stocks at these prices, what you're telling shareholders, the message you're giving them is that a short-term treasury right now pays you 4%. That's what they're telling shareholders. And that's exactly what they're doing. And it's not just Buffett, by the way. Wall Street banks hold more treasuries now than they have since 2007. Net treasury inventories held by these elite firms have surged to an average of $550 billion this year. This basically means that Buffett, banks, hedge funds, they're all selling while retail buys. Why though? Well, there's actually a number named after Buffett for exactly this scenario. It's called the Buffett Indicator. He calls it the single greatest measure of stock valuations. How does it work? It's quite simple. You take the total value of the US stock market and you divide it by the size of the entire US economy. So how big is the stock market compared to the country that it sits in, right? Historically, the average is around 100%. Anything over 130 is overvalued. Anything over 200%, in his own words, is playing with fire. And right now it's sitting at 230%. That's above .com bubble highs, by the way. If the indicator that has your name on it is sitting at record highs, what do? You sit on cash, right? Because everything is overvalued, which is exactly what Buffett is doing. The second thing Buffett is doing is dumping banks right now. Remember how I said in 2008, Buffett waited for Goldman to crash, then he bought their shares cheap? Well, he's selling bank shares right now. I wonder if he plans to buy them back cheap. Why though? Why is he selling banks? That's a question we have to ask, right? Because it's not enough to just say he's selling. We have to think about why he's selling. So banks are sitting on commercial real estate that nobody wants right now. So that's one thing. They have a lot of exposure to commercial real estate. They're also exposed to private credit funds that have started gating up withdrawals. I've talked about this before. This is very bad. And they are lending to a consumer who is leaning on credit cards just to go buy groceries. That's an absolutely fragile flaw. And look, I'm not going to go on about banks, but there's a reason Buffett is getting out, right? But the third and the most important factor in Buffett's decision making is the macro setup. Consumer sentiment is at all-time lows in the US. People in the US are feeling worse about their financial situation right now than they did during the 2008 financial crisis. That is crazy to think about. Like, picture this, the worst financial crisis in modern history. People feel worse now than they did during that. Did you know that pawn shops, by the way, I heard this the other day, pawn shops are seeing a massive influx of middle and even upper middle class people pawning items to pay their bills. That should tell you where the economy is right now. Because when you tie all this together, the picture is bleak. Buffett is cashing up, selling banks and shorting consumers, which brings us to portfolios. What portfolios perform the best in bleak market conditions? Because SPX and NASDAQ are all at all-time highs. So you'd be forgiven for thinking that the 𝗥𝗲𝗃 is the best place to be right now, and SPX and NDX and all that kind of stuff. But like I said earlier, the Bank of America's Sleep Like a Baby portfolio is having its best year since 1933. This portfolio is essentially what the smart money is doing, what I've been talking about for months. And the structure is simple, 4 buckets, equal weight, 25% each. Now, you don't have to follow this exactly. It's just a template, right? 25% in stocks. This is simple indexes like SPX and NDX. So you do have some stock exposure, right? 25% in bonds, 25% in cash, and 25% in commodities like gold and silver. Look, I'm about 35% in commodities, but that's what I said. It's a template. It's not something that you have to follow exactly. So there's no clever overlay, no fancy quant modeling. And this year, that boring four-way split has returned around 26%. Best year for it since 1933. Better than most of the AI crap retail is going all in on. You don't have to copy this portfolio exactly like I said, but you should look at it and discuss it with your financial advisor, right?